Right, good day everyone, and welcome to the second part of Don't Get Lost in Leases. We'll be focusing now on the auditing aspect thereof, um, taking the understanding that you've gained from the earlier session on the IFRS 16 requirements and the detailed discussion you've gone through on the standard, and now understanding how that needs to be applied in the aspect of the audit and the types of procedures that need to be carried out to make sure that hopefully, contrary to the IFRS implementation with the report coming out of the inspections department from the RBA, that we don't have similar concerns in this regard. So what we've got on the agenda is just a quick recap on the effective date, and we'll be looking at that in relation to other auditing standards, so the accounting standard and how that correlates with the effective dates of the auditing standards. We'll then be looking at the planning and risk assessments, procedures, a more thorough understanding of the application of IFRS 16 and how one then goes about carrying out procedures to audit the new leasing standard. We'll then focus on the lessee changes, that being the primary change to the leasing standard from a user perspective. We'll spend some time on the initial considerations. We'll also spend some time then looking at the initial recognition and procedures that would need to be carried out when one has identified a lease and how one's going to then determine whether or not management are accounting for it appropriately, the types of procedures and audit evidence that will need to be gathered. And then we'll be focusing on the subsequent measurement procedures once the lease has been recognized, what happens with the asset, the right of use asset, as well as then the liability, the lease liability. We'll also focus on some lessor accounting, some changes there, and finally look at the lease accounting exemptions. Important to realize that one will also need to consider making specific changes to one's representation letter, the discussions that you have with management and then confirming those representations in writing. And then finally, you will also then need to consider making sure that your engagement letters are up to date, ensuring that you're referring to the latest accounting and auditing standards, the frameworks that are being utilized. We will be taking approximately a 10-minute break after about an hour, and then hopefully another 10-minute break an hour thereafter. So if I can just ask you to just please bear that in mind and synchronize your watches. I will be giving a sort of a reminder about a minute or so before that 10-minute break is up, just so that everybody can get settled. Right, I think then let's get on with the learning and get an understanding of how we need to apply our auditing knowledge to the audit of the new leasing standard. So it's very important then for the auditor to be fully aware of the new standard, particularly the leasing standard, because of the significant changes that are involved therein. And we find that not only does the auditor, the engagement partner, need to be aware of that, but obviously the engagement team, those senior staff also involved in the audit, must also have a thorough knowledge of the requirements of the new IFRS 16 standard. Comment by Sir David Tweedy, previous IASB chairman. It's hard to believe that a lot of airlines use aircraft, but never actually record them on their balance sheets. So, yeah, some changing times ahead. So, the primary distinction between lease accounting now is not so much in terms of the type of lease, but now the requirement is more from a perspective with which one is directly involved with a lease. So the distinction now being between, in the past, between operating leases, which were primarily off balance sheet, and finance leases, which were now on balance sheet. Now we're seeing significant changes, because what we're doing is the focus now is that management need to ensure that operating leases are recorded subject to the exemption, which will clarify the audit work required in that regard. But now that the leases that are being recorded, all leases or commitments to the use of items subject to a lease now are then subject to a similar accounting process. And as a result thereof, particularly for lessees, there's increased disclosure requirements, as well as for lessors, around the leasing activities of the entity, including a table for the types of assets. And therefore, that becomes a critical disclosure, and obviously information which the auditor needs to gain evidence about, so that there is sufficient work carried out to establish whether or not the amounts represented are accurate, complete, and representative of transactions that have been carried out. For lessors, the recognition and measurement principles have been brought forward, mostly unchanged from the previous standard, and therefore the work in that regard, from the auditor's perspective, would not be significantly different. However, there is going to be increased disclosure requirements for lessors where they are have assets that are party to a lease transaction, particularly sort of operating leases that would have been accounted for, and then also the residual value of risks, if they retain any risks involved. The auditor then needs to make sure that they verify those risks to an appropriate contract, and make sure that they've been then adequately examined and understood in terms of the context of the arrangements that have been. From a recap of the accounting perspective, almost all leases now are recognized on in the statement of financial position. And the primary difference is how then that is going to be recognized. With a lessee, the obligation, the responsibility to recognize the asset is as a right of use asset. And therefore, the auditor will be required to establish which assets the entity has a right of use over, which assets management have included procedures to identify that right of use, and very importantly, which areas they have not, so that there can be adequate procedures to identify recorded transactions, unrecorded lease assets. Very importantly also is that with regards to the balance sheet, the assertions about account balances and related disclosures haven't changed, and therefore the existence of the assets, the completeness, all the assertions that we are familiar with, sufficient evidence will need to be obtained with regard to all of those. With regard to the assertions, remembering that the assertions cover transactions and balances and their related disclosures. So therefore, when auditing the different aspects of a lease, the information and procedures to verify what will be disclosed will also need to be obtained. The existence assertion would relate to the right of use asset in a traditional old operating lease, and then the right to receive those payments if the entity is acting as a lessor in a lease. The operating aspect, the operating leases with regard to the rights and obligations would then give rise to an appropriate corresponding lease liability and evidence that the entity holds or controls those assets or is entitled to recognize or must recognize the liability corresponding to its right to receive rentals in a lessor environment would be part of the engagement team's procedures they would need to carry out. All lease assets, as well as the corresponding liabilities, would need to be recognized in the appropriate aspects of the statements of financial position and, where relevant, in the statement of comprehensive income. And then, very importantly, because of the complexity and complex calculations sometimes involved in leases, as well as the valuation and allocation thereof, the entity would need to demonstrate how the accounting has arisen at appropriate amounts being recorded relating to the lease liabilities as well as assets, and then the corresponding amounts reflected in the entity's profit and loss, and that they are appropriately measured and described. The classification between assets, liabilities, and equity, as well as the corresponding income statement, would also need to be verified. And then how the amounts are reflected in the assets, liabilities, equity interests, statement of cash flows, that they are appropriately aggregated, as well as sufficient detail given to clearly describe the disclosures relevant so that they are understandable in the context of the requirements of the new leasing standard. In terms of the evaluation and auditing of leases, the first procedure to be carried out is to determine whether or not a lease is actually in place, and therefore whether a corresponding liability should be recognized. And these procedures will then relate directly to the existence assertion, as well as the rights and obligations that arise therefrom. It should be noted that the procedures to determine whether a lease exists and the inspection of the lease contract do not address the valuation assertion at initial or subsequent measurement, and alternative procedures, as we'll be discussing later, will need to be designed in that regard. In terms of the evaluation of a lease and a contract, the first key point is to identify the process that management has put in place for the evaluation of all contracts to establish whether or not that process is adequate so that it is likely to identify all contracts that result in lease transactions. The primary starting point is the identification whether or not, based on the contract, there is the use of an identified asset. Because if that requirement is not met, then no lease exists. Thereafter, the entity would have to ascertain whether or not there is a right to obtain substantially all of the economic benefits from the use of that asset throughout the period. If that is satisfied, the next hurdle that the entity would need to evaluate the contract for is whether or not the customer or supplier or neither party have the right to direct how and for what purpose the asset is used throughout the period. If the supplier has that right, well, then it's not a lease. If it's a customer's responsibilities, part of their rights, well, then we have a lease transaction. If neither of the parties have that, then the question would be is whether or not the contract is structured in such a way that the right to operate the asset by the customer for the period of use without supplier having the right to change those operating instructions is in place. If that's satisfied, once again we have a lease. If that's if the supplier has the contract, has the rights in that regard, well then the final step to determine whether or not a lease is in place would be to determine whether or not the customer designs the asset in any way that predetermines how and for what purpose the asset can be utilized. This would then need to be verified by the engagement team to select contracts and verify the controls and applications that management have carried out. And if a lease exists, then the audit team would then be required to confirm what the right of use asset is and physically verify that asset on a sample basis, and to make sure that then the lease asset as well as the corresponding liability has been recognized in the financial statements. What if a lease agreement contains other components, matters that relate to a lease, or as well as matters that relate to non-leasing components? So an example would be, for example, where an entity has entered into a use of equipment, but that equipment also comes included in the same agreement is some sort of maintenance or service requirements, and therefore the entity has then a right of use of an asset, but then also has a contract whereby the supplier of that item, that specific asset, is then required to service that at regular intervals, common in the airline industry, as well as in something common day-to-day equipment, office equipment that one would lease in terms of photostat machines, those sort of items, subject of course to the exemption, which we'll clarify at the end of the session today. So let's now have a look then how one applies the new standard to a lease to identify individual components. And the first aspect is, as much as practical, the company may account for a single lease or a portfolio of leases, provided the characteristics of the portfolio are similar to each other, and it's reasonably expected that the accounting for each component individually will not differ materially than the accounting if it were treated on a portfolio basis. The assumptions under a portfolio basis, as well as estimates then that had been taken into account, would need to be clearly disclosed as part of the accounting policy, as well as then in the accounting policy the discount rate used in terms of the carrying the lease liability, as well as the lease term, and how determined for a portfolio level or based on the individual assets, if we'll see their potential extensions included in the contract. And then the company would need to also specify the lease payments in the notes, as well as the incremental borrowing rate, a specific new term that we need to come to grips with. And the auditor would then need to make sure that the disclosure in the financial statements is appropriate. And then finally, the fair values relating to the components of the contract would also need to be appropriately disclosed. Right, so time for you to think now. Picture the following scenario. A company enters into 50 individual leasing contracts for similar assets during the first month of the financial year. The leases have terms of 2 years but commence on different dates within the same month, and the annual lease payments are expected to be between 2,000 and 3,000 Rand per each leased asset. A separate lease exists and would need to be accounted for separately under the standard. However, Company X reasonably expects that the effect of applying the new standards to the 50 leases as a portfolio will not materially be different from applying it individually to each lease, because the terms and conditions are similar for each lease contract, including similar start dates and a narrow range of fair values for the underlying assets. Time for you to think, what audit procedures do you believe would need to be carried out by the engagement team? I'm going to let you think for a moment, and please, if you have any comments or suggestions, please feel free to submit them in the chat. So the first would be is whether or not the accounting policy disclosed in the financial statements has been appropriately considered and disclosed that they are applying the portfolio basis. The engagement team would also need to obtain an understanding as to how management applied their judgment to reach the conclusion that the portfolio approach may be followed. What evidence is there that the portfolio treatment is not going to be significantly different, not materially different, from recognizing the assets on an individual basis? And then the engagement team would also need to verify that the leases reflect the similar size and composition of the portfolio, based on inspecting the individual lease agreements and confirming that the terms of the leases, the underlying assets, as well as fair values, are similar as purported by management. And then finally, the incremental borrowing rate would then also need to be verified and evaluated compared to the different contracts to make sure that there is no no significant difference between the individual leased assets, the individual contracts, and what ultimate IBR that the entity management have decided to utilize in the portfolio calculation. Often with leases, one needs to make sure that one evaluates what is included in the lease contract. It is very common for lease contracts to contain an element that is a lease component and then a non-lease component, as mentioned previously, where one has, for example, a service or maintenance plan included in the lease contract. Many arrangements include such two aspects, two separate lease components and non-lease components. And many entities do not separate the operating lease component in the contract because the accounting from an operating lease perspective and for the service or supply of the arrangement in the past has been similar and resulted in very minimal difference in treatment in terms of the financial statements. Under the new leases standard, however, there's substantially different accounting treatments for the lease component versus the non-lease component. And therefore, the entity needs to make sure that it accounts for the lease component in accordance with the requirements of the standard, and therefore the entity also needs, if there is a fixed fee, would need to allocate the fees between the lease and non-lease component based on relative standalone prices of the lease component, if available, and then the aggregate standalone prices for the non-lease component. And this would then be a way in which the lease payments or the payments in terms of the contract can be allocated and appropriately evaluated and split between the lease and non-lease components. The lessee can benefit from the use of the asset either on its own or together with other resources that are readily available to the lessee. And readily available resources are goods or services that are sold or leased separately. This is part of that evaluation to determine what the standalone price could be. It's important to understand whether or not the underlying asset is dependent or highly interrelated with underlying assets, because then the identification of lease and non-lease components payments should be allocated based on how then the lessor should apply the requirements of IFRS 15, the revenue contracts, being a very similar process which looks at allocating the transaction price between different performance obligations. The starting point to recognize a lease would be the commencement date, because that would then determine the date at which the right of use of asset needs to be recognized, as well as the corresponding lease liability. And that is generally the date that the right of use of the asset, that the asset is made available to the lessee. The auditor would need to then inspect supporting documentation to establish what the date of right of use was. This may be, for example, delivery notes or occupation certificates, which would then give the auditor sufficient evidence to determine that the initial accounting is at the appropriate period. This would obviously be highly important to establish if lease agreements are entered into close to year end as to whether or not there is any lease liability to be recognized from a cut-off perspective, because that would clearly indicate whether or not a liability exists and the entity has the right to use an asset at a particular date when the year end arrives. The right of use of an asset is calculated based on an estimate, and that estimate is the sum of the amount of the lease liability as well as any initial direct costs. Also included would be lease payments made before or on commencement date, as well as any lease incentives that are part of the contract. And then finally, any additional costs of dismantling or restoration costs, restoring the asset to its original condition prior to the contract commencing, those would be aggregated together, which would then form the value of what the right of use asset needs to be reflected in the financial statements. Obviously, these components then we'll be looking at in further detail would then need to each be verified by the auditor. In terms of the initial measurement of the right of use asset, that's dependent, as we said, based on the value of the lease liability. So let's then look at the process that management would have to follow to recognize the liability, which would then be the first input into the right of use asset, which would then need to be verified by the auditor. So remember that when information is provided by management, the engagement team should obtain sufficient appropriate corroborating audit evidence in support thereof. So the first information that would be obtained from management would be the schedule of the calculations of the lease liability. And ISA 500 says that where information is produced by the entity, the auditor is required to carry out procedures to ensure that that information is sufficiently reliable. So one would need to verify the lease payments to corresponding contracts, etc. Evidence is also required that the calculations have been accurately made, and the completeness of the information, for example, the terms, the number of leases, if one's doing it on a portfolio basis, and evidence would also need to be gathered to determine whether or not the amount at which management have reflected the liability is appropriately precise and sufficiently detailed to meet the requirements for which it is being calculated. So the first input then would be the present value of the lease payments and whether or not that is appropriately discounted. The way in which the accounting standard requires management to measure this is at the interest rate implicit in the lease. And please, it's important to realize that management need to attempt to obtain that information. And the auditors would need to verify what steps were taken by management to obtain the information from the lessor to calculate the interest rate that is implicit in the lease, because this is the discount rate which should be used by the lessee in calculating the right of use asset and ultimately the lease payments which form the basis thereof. Only if that cannot be determined, then the auditor would need to verify how management were unable to do that, and then the auditor would be able to verify how management calculated the incremental borrowing rate, because that is not automatically an allowed alternative. It's only where the information is not readily available, and therefore in group scenarios it's unlikely that incremental borrowing rate would be used, and therefore the auditor should be very skeptic if that is a situation that has led to the lease payments being discounted at an incremental borrowing rate, because either then the entity is not necessarily a related party or an entity over which the company has control, or the accounting may be inappropriate under the circumstances. So let's then now look at, with regard to the next aspect, let's say one obtains this schedule to calculate the lease liability, and the schedule would look something like this. I'm going to give you a couple of moments to think about what procedures the auditor and the engagement team would need to carry out. Right, you're welcome to submit your proposed procedures on the chat. So the first procedure would be to check the calculation for mathematical accuracy. So the numerical calculations and mathematical calculations would then need to be reperformed. And the next aspect is that the calculation of the lease term in terms of this lease liability calculation has been set at 5 years. That would need to be verified to the contract, and we'll discuss that in due course, what could affect the lease term, what would possibly extend that lease term beyond the standard requirements. This will be important when calculating the incremental borrowing rate as well. The discount rate or the borrowing rate, the IBR, the percentage used there would need to be verified to determine how that has been calculated. Furthermore, the inputs into that incremental borrowing rate, as well as the estimates, would need to be clarified to determine whether or not there is any information that is based on observable or unobservable rates, because that would then give rise to the IFRS 13 disclosures. And it would also be highlighted that the incremental borrowing rate must not be the internal rate of return on the lease. And finally, one would then also need to establish whether or not obviously the contract is in the name of the entity, and the final summation to arrive at the present value of the minimum lease payments is accurately recorded. So we spoke about the lease term, and generally the lease term would be the non-cancelable period, but one would need to make sure that one evaluates the procedures carried out by management to determine that they have looked at the lease contract to identify whether or not there are any extensions, and the engagement team would need to then consider what is the non-cancelable period in terms of the lease agreement, in terms of the extensions. Are there extensions included in the lease agreement which it is reasonably certain that the lessee would exercise if they have the option? That could be because they are at favorable market conditions. And then also, are there any periods covered by an option to terminate where it is not reasonably certain that the lessee will not terminate the lease? Because those periods would then also need to be included in the lease term. So in terms of that 5 years of the previous example, these are all the aspects that need to be included, and that the auditor would need to look at the summary of how management have evaluated the contract to determine whether or not such clauses were indeed present in the financial statements, in the lease contract. When considering management's intentions, the engagement team would also need to obtain sufficient appropriate evidence to verify management's intention and resources to carry out their plans, so that that is incorporated in the lease term. For example, broader economics of the contract, and not only the contractual payments. If the contract creates economic incentives not to terminate the lease, to the extent that a significant penalty would be incurred on termination, then the contract is enforceable beyond the date on which the contract can be terminated, and therefore this should be included in the lease term. Other aspects to consider is whether each of the parties has the right to terminate the lease with or without permission of the other party, with no more than an insignificant penalty. For example, a lease is no longer enforceable when both parties have such a right, or if only one party has the right to terminate the lease with a permission from the other party, then the contract is enforceable based on the other party being unable to terminate. So these matters would need to be included in the evaluation. Right, so with regard to the procedures to verify the lease payments, so the auditor would need to obtain the schedule prepared by management, and then there should be observable data that this can be verified towards. That would be the fixed payments, less any lease incentives receivable that would be per the lease contract. The auditor would also need to inspect the lease contract to determine if there were any amounts that would be subject to a variable lease payment that depended on, for example, an index or some sort of a rate, and therefore that would also need to be estimated. And then the any guaranteed residuals would also be need to be estimated, if not specifically stated in the contract. And in calculating that, the requirements of ISO 540 would need to be applied, and the three approaches available in terms of the revised standard would need to be considered in working out to audit management's calculations in that regard. Whether or not there's any exercise price of a purchase option, if that's reasonably expected at inception of the lease, that would also need to be included in the lease payments, as well as any penalties for terminating the lease if the lease term reflects that the lessee is likely to be exercising an option to terminate the lease. So all of these matters would need to be verified to the lease contract. That brings us to an appropriate time, I think, to break for our tea break or leg stretch, or whatever you'd like to do. So I'm going to propose that we break for 10 minutes and then we'll resume thereafter. So please synchronize your watches and we'll be back just now. Right, everyone, if you can start getting ready, we'll be starting in about a minute. Right, so let's now look at the incremental borrowing rate, and the purpose of explaining this estimate does not take into account the consideration of the auditor's risk assessment, but is going to be focusing on how to audit the incremental borrowing rate. So the auditor can either test how management made their estimate of the rate, or they could use their own independent assessment, whereby they look at developing their own point estimate or range, those two allowable alternatives in terms of ISA 540, and then they would establish how management range, where management range fits within their range, or how close to management's estimate their point estimate is, and then establish whether or not that is appropriate under the circumstances. The other approach would be to test management's assessment, and that would then involve the auditor evaluating the method used by management to arrive at the IBR. That would include an assessment of the appropriateness of the circumstances that management had utilized, as well as any assumptions that management had made to arrive at the IBR. The incremental borrowing rate, the auditor there would need to look at how management had determined the rate at which it would borrow to acquire the right of use asset. So not the underlying asset, but for the facility to the additional facility for the liability to acquire that asset. This incremental borrowing rate should take into account the lease term, which would obviously be verified to the contract or other workings that the auditor had carried out. The rate should take into account the security being the relating to the asset. Included in the calculation should be the entity's credit rating, or if that's not available, an entity with a similar credit rating, similar economic environment, but would exclude any costs of equity finance. In other words, not the entity's weighted average cost of capital, because that includes an equity component, and therefore equity finance would not be relevant to the incremental borrowing rate. The auditor would need to test management's assessment of the calculation of the IBR, the method utilized. The first aspect thereof would be to determine whether or not the method utilized by management in the calculation of the IBR is consistent with the requirements of IFRS 16. For example, something like weighted average cost of capital would not be an appropriate basis to utilize an appropriate rate to utilize in the calculation of the IBR. The engagement team should also ensure that the method of calculation includes those considerations as detailed in IFRS 16, discussed as part of the first session this morning, to make sure that all those factors are included to arrive at the calculation. Very importantly, the assumptions would also need to be verified. The engagement team would need to ascertain how management obtained the information on which the inputs were based, as well as the terms of the lease. Is that is observable data, which can be verified to a lease contract, as well as whether or not the assumptions indicate and correspond to the economic environment in which the entity is operating. And finally, the auditor needs to apply professional skepticism and be alert for possible indicators of management bias in the calculation of the IBR. Remember that part of this evaluation would be a step-back approach to look at other estimates where management have been involved, and to determine whether or not management were on the upper or lower range of those estimates, and if management are always utilizing inputs, assumptions that tend to a upper or lower range of a value of an estimate, that could be indicative of management bias, which the auditor would need to evaluate the impact thereof. Should the auditor have decided to utilize a point estimate or range, they would need to make sure that the range is calculated in terms of the method outlined in terms of IFRS. Once again, looking at whether or not there is any observable data that's been included, and whether or not that can be verified to any contracts. The auditor would need to adjust the range estimate based on their assessment of factors such as economic or entity specific, whereby if the client itself may have different risk ratings to information utilized by the auditor in calculating their range, and then that would need to be compared to management's estimate of the IBR and the impact and consideration of whether or not this would lead to a material difference would need to be considered to determine whether or not the auditor was satisfied with the estimate, with the IBR calculated by management. Both the initial direct costs as well as lease payments might be apparent from the commencement date of the lease, as well as any lease incentives. Such observable data can be verified either to the lease contract or other supporting documentation without the application of estimates. Although the auditor can use the method of calculating their own point or range estimate, determining the dismantling or restoration costs are normally complicated, and therefore it's often necessary for management to utilize an expert and sometimes the auditor may require an expert to assist with such a calculation. For example, if the dismantling or restoration costs relate to a landfill site, which would be outside the competencies and capabilities of an auditor, normally an engineer may be required, and therefore the auditor would need to consider the use of an expert under such circumstances. In that regard, we would recommend that auditors look at the RBA and CICA's frequently asked questions done in conjunction with the inspections department of the RBA, which focuses the auditor's attention on the use of experts and the extent of procedures and considerations that need to be incorporated in the audit procedures, particularly where management have appointed an expert, and what the auditor's responsibilities would be in that regard. Once the lease liability has been calculated and capitalized together with the corresponding lease asset, the auditor would then be required to consider how management had measured that asset since initial recognition. And the procedures that would then need to focus on would be the individual items arising from the lease, and those would be the right of use asset as well as the lease liability. So let's have a look at each of those individually. The subsequent measurement of the lease liability would be impacted by the following transactions arising from the actual lease. The liability would be increased as a result of any interest calculated on the liability. Any lease payments would ultimately reduce the value of that liability, and then there may be remeasuring the carrying amount to reflect any reassessment or lease modifications to reflect revised in substance fixed lease payments or anything that arises from the lease. The interest on the lease is the RBR rate calculated at initial recognition, which the auditor would need to verify for mathematical accuracy. The lease payments should be reflective based on the schedule of lease payments to recognize the initial lease liability at inception, and then there may be further adjustments as a result of any modifications which the auditor would then need to verify that such changes had taken place, that this information was not contrary to the amounts reflected in the actual lease term, and these values, these payments, etc., if already made, would need to be verified to statements from the bank, supplier statements, or the lease contract. Obviously, that wouldn't apply to the modifications. So changes in the lease liability may arise from numerous factors, one of which could be the change in the lease term. In other words, an extended or reduced period. This could be as a result of a change in the assessment of an option to purchase the actual asset, which would then need to be evaluated based on the reasons and what had changed that gave rise to the management now having a different intention. There may be a different amount payable under the residual value of the contract based on management's estimates, or a change in an index or rate used to determine the lease payments, the IBR or something that, if we're appropriate. So this would then need to calculate the revised payments based on these factors. Also important is that these revised amounts would need to be checked whether or not there was any errors rather than changes to the reassessment of the lease liability. The discount rate would have been based on management's best estimate, and the engagement team would need to verify the reasons for the change in arriving at the new rate as to why factors are changed to give rise to that. The same rate should be used unless there's changes as a result from variable interest rates. That's a valid reason, but one would need to evaluate that under these circumstances. The adjustment would then need to be made to the right of use assets, and then the corresponding entry would be the profit or loss. Remember, when performing audit procedures on information supplied by management, all these proposed changes would once again be subject to schedules prepared relating to the leases from management information, and the engagement team would need to carry out sufficient procedures to ensure that the information produced by the entity is reliable, verifying it to the initial contracts, verifying it to an understanding of changes of intention and rationale for those changes, and there's always a risk that the information will not be complete. We'll be addressing that in a bit more detail in the coming slides. And then, very importantly, that there is sufficient working papers that document the procedures carried out, where the accuracy of those calculations and the precision of those calculations is described in sufficient detail to establish whether or not management have indeed met their responsibilities in terms of complying with the lease. So we've spoken about the subsequent measurement of the liability. Let's now focus briefly on the right of use asset. And how would the right of use asset be measured? So the right of use asset would be measured and subsequently accounted for in accordance with the accounting standard as if the entity owned the asset outright. So I'm going to ask you now to think any examples that you could come up with, any IFRS standards that would be applicable to the measurement of the right of use asset subsequent to its initial recognition. I'll give you some time to think about that. Please feel free to submit them on the chat. All right, just a couple more moments. Right. So I think what we need to focus on is the types of assets, types of items that would be subject to a lease, and the most common would obviously be PPE, which would then need to be measured over the useful life of the asset. Very importantly, to make sure that the asset is depreciated over the lease term. That would represent the way in which the economic benefits of the asset are being utilized. Another example would be the intangible assets, particularly computer software. Computer hardware obviously would be subject to the same requirements as the PPE. And once again, that would then need to be depreciated over the useful life of the asset, and obviously could not exceed the lease term standard. When it comes to verification of information, the information prepared by management needs to be assessed and verified for completeness, i.e. that all leases have been recorded on the schedule and all leases have been accounted for appropriately in terms of the requirements of IFRS 16. There are various audit procedures that can be designed to identify leases that have not been recorded. For example, payments made after year end, where the lease payments were subsequent to the year end, and whether or not these have been included in the lease liability at year end. Original documentation could also be looked at. And let's have a look at some other ways. In larger entities, management would generally issue formalized assessment criteria to establish how leases would be evaluated, how contracts should be evaluated to determine whether or not a lease is present. However, this is not a requirement, and if management did have a system in place which was utilized to assess agreements or contracts for the presence of leases, the engagement team would need to evaluate that process and determine whether or not the controls in place thereon could be relied on to establish an understanding of those principles applied, and whether or not there were any contentious issues or risks. It should be highlighted that this would not negate the need to include substantive procedures that the auditor will carry out as to the existence and recognition and valuation and measurement, be that at initial or subsequent measurement of the actual leases. In smaller entities, the engagement team could use substantive procedures and independently assess management's application of the requirements of IFRS 16 where management have not included a formal process to identify such leases. As discussed during the accounting section, once the entity has identified the contract, the entity would then need to carry out the procedures to determine whether or not the lease is within the scope of IFRS 16, if the contract is a lease, and whether it wishes to apply any of the exemptions allowed in terms of the leasing standard. With regards to lessees and the verification of the completeness of the leases. Procedures could include looking at recurring payments, a list of recurring payments, be that from accounts payable or looking at invoices paid on a regular basis to determine whether or not there are any payments that weren't included in the lease liability. Based on knowledge of the business, bank statements could be reviewed, or monthly debit orders to establish the presence of possible lease liabilities that hadn't been brought onto the accounting records. And then one would also need to include discussions with management to establish whether or not there were any agreements signed relating to leases, as well as the review of minutes of directors' meetings or management meetings that are available to determine whether or not there were significant contracts signed for the acquisition of right-of-use assets or leases as a lessor that the entity may have carried out. Other ways in which the entity could look for leases could be a review of tax returns with regard to deductions claimed regarding lease expenses. Looking at the entity's business model. Is it a company policy whereby all vehicles, company vehicles or trucks, delivery vehicles are utilized, are acquired by way of a lease? And then also making sure that the financing structure and assets are representative of the way in which the entity operates in an asset-intensive industry. One would expect assets to be included in the fixed asset register, PPE, significant plant and equipment, and therefore the auditor could review the fixed asset register, the FAR abbreviation there, to determine whether or not there is a presence of such assets, or if not, that could be indicative that there may be lease agreements that had not been appropriately accounted for. So the search for embedded leases also relates to the completeness assertion, and there are sometimes unidentified leases included as part of a larger contract or agreement, and these leases are often overlooked. For example, a lease for alarm equipment could be part of a larger agreement which includes security services, or there may be an embedded lease for servers, capital software that may be included as part of a larger IT service contract. And the auditor would then be required to establish whether or not what management processes have been to identify such embedded leases in contracts, whether or not these procedures have been carried out, anything by management, and the entity needs to account for each lease component within a contract as a separate lease from the non-lease components, unless it applies the practical expedient, that being that a lessee may elect by class of underlying asset not to separate non-lease components from the lease components, and instead account for each lease component and any associated non-lease components as a single lease component. So the entire transaction would then need to be treated as an embedded lease, and therefore would need to be treated accordingly, and therefore the same procedures that we spoke about for the initial measurement, initial recognition of the underlying asset, the right of use asset, as well as the procedures for the calculation of the lease liability and how that's made up, would all need to be carried out. Right, now that we've looked at the lessee accounting, let's go on to the other types of leases IFRS 16 deals with, or the accounting from the lessor's perspective, I should rather say, and what the procedures are with regard to the auditor's responsibility and what's changed in that. Right, so when it comes to the treatment of lessors, so primarily no significant changes to the lessor accounting from the previous IAS 17 standard. Initial measurement would take place on the commencement date. That would be the date that the lessor makes the asset available to the lessee. And the asset then that would be recorded would be the lease payments receivable stemming from the contract with the lessee. The entity lessor would have the right to receive those lease payments receivable. And then from the perspective of the corresponding entity, the liability, the lessor would have a responsibility and obligation to provide the asset, so a performance obligation, for want of a better word, whereby the lessor would be entitled to utilize those benefits over a period of time, that being the lessor's obligation to allow use of that asset in terms of the lease contract. So the interest rate in the lease, the implicit interest rate, would be utilized by the lessor. In a lease, as mentioned, for lessees, this is often very difficult to obtain because this is often treated as confidential by the lessor, because this is the return on the transaction which they would be earning, and therefore they would often be reluctant to disclose this information with those with whom they are transacting. So in terms of the calculation of the implicit rate of interest in the lease for the lessor, remember this is the rate at which the lease payments would be discounted for the lessor. The first input there too would be the present value of the lease payments, and the auditor would need to obtain a schedule thereof from management. Obviously, this would need to be verified to the actual lease agreement to ensure the amounts which management are purporting will be received have actually been corroborated. And then added to that would be the present value of any unguaranteed residual, so the amount that would be received or paid at the end of the lease term, and that then would equate to the fair value of the leased asset. And then the only amount in addition thereto that the lessor would be entitled to capitalize would be any direct costs in setting up the actual lease agreement. From the perspective of the unguaranteed residual, that would be an estimate, if not explicitly mentioned. Often it may state a percentage of market value or something, but on very long-term leases, this could be quite difficult to obtain, and the the auditor would then need to evaluate some sort of a point estimate or range, and if compare that to the method in which management arrived at their present value of the unguaranteed residual. The amounts then would need to be collated, and the mathematical accuracy thereof would also need to be verified, just like we were doing on the procedures relative to the lessee and that table prepared, the schedule prepared by management. And then the initial costs are often also not available to the lessee, and that would also then make the calculation for a lessee that much more difficult to establish. Some common pitfalls that have been identified by the regulator is the internal rate of return of the lease is often treated as the interest rate implicit in the lease, and that isn't necessarily correct, and therefore that would need to be made sure that the auditor establish the basis upon which management have calculated that internal rate, interest rate implicit in the lease. And often this rate is utilized by the lessee, which, as mentioned before, is contrary to the requirements of the standard. And the challenge is then to make sure that the lessee utilizes the correct, appropriate rate for their purposes, as mentioned before, the rate implicit in the contract, or otherwise the incremental borrowing rate would need to be applied by the lessee under the circumstances. From the perspective of completeness, to make sure that the lessor has recognized and accounted for all contracts with leases, once again, tax returns, prior year tax returns can be utilized, or the current year tax return if that's available, to establish the deductions being claimed by the lessor in this regard. This would then give an indication of possible leases that the lessor has not calculated, has not recorded. Knowledge of the business, where a review of the fixed asset register can be conducted, but little evidence that these could be used for business purposes, so therefore one would need to have a thorough understanding of that, and a detailed understanding of the processes and operations conducted by management for this to be utilized successfully. And one would also then need to consider discussions with management to establish whether or not there are any transactions that they've entered into where they may be acting as a lessor, as well as a review of significant minutes of meetings, directors' meetings, management meetings, to establish whether or not there are any such new contracts that may have been signed, to establish whether or not there could be any lease contracts that may be missing. We'll be doing one more slide just before another quick coffee break or leg stretch, whatever you need to do. So in terms of the other procedures that could be carried out, looking at debtors transactions outside the normal course of business, some sort of receivables, making sure that the amounts reflected are indicative of amounts reflected in the financial statements. Are there any receipts subsequent to year end, which may indicate leases signed close to the year end, which may need to be recognized and brought into the books prior to the year end with a corresponding liability. Could also be a review of monthly debit orders received based on the leases that have been signed with the customers of the entity, particularly with existing customers, maybe increased payments that could be ascertained, which may give rise to new leases that may have been signed. And then possible other matters that could be looked at could be unusual payments, such as the state agent payments. These payments could be reflective of some sort of lease agreements signed for rental property, if that's the industry in which the entity may operate. Right, I think we're approaching nearly 2 hours, and therefore I'm going to propose another 10-minute tea break, after which we'll then look at the disclosures, audit of disclosures, and then just tying up some of the final aspects. Right, everyone, if you can start getting ready, we'll be starting in about a minute. Right, welcome back. Let's have a look at the last couple of sections looking at disclosures as well as the exemptions from the accounting standards IFRS 16 to make sure that we cover everything. So with regards to disclosures, we know that disclosures is part of the assertions, and with regard to the assertions relating to transactions, one needs to look at the audit of those disclosures together with the transactions, and the same applies to the account balances. So let's now have a look at what needs to be presented in the financial statements, because that information needs to be verified as well. Just a caution with regards to the statement of cash flows, the regulator is watching that area significantly, particularly in the area of non-cash items. So where one is entering into transactions, signing a lease agreement as a lessor or as a lessee, well, there would be no initial acquisition of any asset. And those transactions, just like with the old IAS 17 leasing standards, those would need to be reversed as non-cash items. Here now we have the added area whereby the right of use assets together with the corresponding liability in the lessee's books would also be a non-cash item. So let's then have a look from the statement of financial position. There would need to be the disclosure of the right of use asset, that right of use asset together with the accounting policy as to how the right of use asset is recognized, how it's subsequently measured, as well as any impairment considerations would need to be included. And the right of use asset could be included in the same line as similar owned assets, with disclosure by way of the notes or somewhere, which would give an indication of the value of right of use assets included in the same category. There may be investment property as well, and that would then need to be disclosed in terms of IAS 41. The auditor would need to make sure that management had measured that appropriately. There may be use of experts, valuers, independent valuers, and the disclosure thereof would also need to be verified. And then the lease liabilities would need to be presented in the financial statements. Once again, could be reflected separately or included in other liabilities, and then a line item in the notes reflecting the value of lease liabilities that the entity has incurred. Remember, the terms thereof would also need to be verified together with the payments. These are all amounts that we would have verified previously. Now we're just focusing on them in terms of how they would be presented in the statement of financial position. From the statement of profit and loss, they would also need to present the interest on the lease liability separately from the depreciation on the right of use assets. So those two items would then need to make sure that they are adequately reflected and that the auditor has verified the amounts that are disclosed, and then where relevant, a impairment may also need to be considered. Remember the concerns around accounting estimates, residual values, useful lives, those aspects would also apply, and the auditor would need to gain sufficient audit evidence that management have applied themselves appropriately to ensure that the asset has been, right of use asset has been appropriately measured subsequent to the initial recognition. That being a big concern, and obviously the residual values and useful lives would need to be assessed on an annual basis, and where such amounts may have been written down to R1 or fully written off prior to the asset being to the lease term having been concluded, that would obviously be indicative of the residual values and useful lives not being appropriately applied by management, and therefore the auditor would need to consider that and possible evaluation of the aggregate of all such right of use assets to determine the possible impact and misstatement in the financial statements. Right, moving on to the exemptions. So with regards to exemptions, it's important that one looks at contracts, and there are certain lease contracts where an exemption may be allowed, which would allow the entity not to recognize the lease. So let's have a look now at that in a bit more detail. So the exemptions, management must make an assessment whether to apply the exemptions, but determine its accounting policies as well. And therefore, management needs to be careful that when they first adopt the standard, they need to consider what exemptions they are going to be utilizing, because that may give rise to a change in accounting policy, and then the auditor would need to verify that management then had reported the requirements in terms of IAS 8, change in accounting policies, and possible third balance sheets that come with that. So that's why that's very important. So the process that management have followed and how they've arrived at what they will be utilizing, which exemptions they will be making use of. In terms of understanding the accounting, the engagement team has to assess whether or not management has complied with the requirements for applying the exemptions. So the accounting would need to be understood, because it's only short-term leases, so leases with a term of less than 12 months. Those leases, management is entitled to decide not to treat them as leases. That would need to be disclosed. And the other exemption is in relation to low value assets. That would then need to be evaluated and assessed as to how that is applied, and the auditor would need to then get sufficient evidence to see whether or not that's been appropriately applied. And once again, the auditor would need to make sure that that's been consistently applied on a year-on-year basis. Incorrect assessments could result in the completeness of the statement of financial position being compromised because leases which should have been recognized have now been omitted from the financial statements, as well as classification and occurrence in the statement of financial performance may also be incorrect as a result of the incorrect treatment. Amounts may have gone directly to equity rather than assets and corresponding liabilities having been appropriately recognized by the entity. So with regard to the exemptions, the application would need to be reflected by management in an accounting policy, and the auditor would need to carry out procedures which would include inspection of lease agreements to verify that firstly lease terms are not more than 12 months, and then also that the lease term takes into account all the possible clauses of the contract, which would include the non-cancelable period, extensions where it's reasonably certain that the lessee will exercise that option at the end of the lease, as well as any period covered by an option to terminate where it is reasonably certain that the lessee will not terminate the lease prior thereto. And then included would also need to be any purchase options that the lessee may wish to take advantage of in terms of the lease. So this information would all need to be verified to the contract to make sure that it was appropriately applied in terms of the entity then utilizing the exemption, because this could simplify the accounting for leases and a risk that management may utilize this when the lease doesn't actually meet the terms to allow for the exemption. In terms of a short-term lease, there's allowance that the short-term leases being less than 12 months can then not be accounted for. There would need to be adequate review of the underlying assets as well as the agreements to make sure that this has been once again appropriately applied, and then also ensuring that the correct application of the current operating leases has been appropriately recognized and treated by management under the circumstances where they are utilizing this exemption. Then, furthermore, the low value assets, one would need to make sure that one clearly understands how management has arrived at the low value, possibly a disclosure thereof in the accounting policy, what management deems to be low value, and then a sample of assets verified to ensure that they have been classified appropriately, all such assets as low value, and that the criteria as low value has been complied with as defined by management in compliance with the standard. With regards to adding value, very important that people be productive and focus on tasks which would allow them to add the highest value to their clients. So on low value items, just focusing on factors that would need to be considered as to see whether or not management has applied the requirements of the standard appropriately. there would be an assessment based on the value of the new assets, regardless of the age. So even if an entity is acquiring an asset for 9 months, because that's its remaining life, the assessment would need to be based on a new asset. The assessment would need to be applied regardless of materiality of the item to the lessee, and therefore this would need to be applied across the board in a consideration as to how management have actually applied this and consistently applied it. Entity-specific inputs would not be relevant. For example, whether or not there may be additional costs that could be capitalized because the entity utilized borrowing costs to acquire the asset. And then the low value items would need to be applied on a lease by lease basis, and the auditor would need to make sure that that had been appropriately considered and applied by management. Then with regard to the first time adoption, so there would need to be a evaluation of the process performed by management to ensure that the completeness of all assets and liabilities that should have been recorded have been recorded, and the related disclosures have been made in the financial statements. The process applied by management would need to be examined and evaluated for possible weaknesses in not identifying the all contracts that could be subject to leases, and then making sure that all leases that met the definition of a lease were appropriately recognized in terms of the methodology and requirements of the standard as we've discussed. And then finally, very important that the auditor keeps a record of all the procedures that have been performed, required to evidence the gathering of audit evidence to fill that bucket required. The regulator continuously emphasizes that if something is not documented, it's taken as not having been performed, and the extent of documentation must be that the type of procedure, when the procedure was performed, and how much verification was actually conducted needs to be reflected appropriately in the working papers. And then the extent of documentation must be sufficient to enable the a uninformed party to reperform the tasks and ultimately arrive at the same conclusions that the engagement team did based on a cold review of the working papers put forward as part of the engagement file. That brings us to an end of the session. I'm not sure if there's any further questions. If there are, please feel free to submit them. Otherwise, thanks very much for your time, and enjoy the rest of your